Hey guys, welcome back. I hope you had a really great weekend. So we did open SPY last week right here, and we closed SPY last week right here. So you can see that we had a completely flat week, and the opening move last week, we did move up and got rejected at this bear gap from the previous week. That bear gap also has the 200-day moving average and the 35 EMA on the weekly time frame. So we got rejected right at that bear gap, didn't get in even 1 penny from that previous Monday's bear gap, and we got pushed down. And this was right before FOMC. FOMC, we got back above the 35 EMA, bounced right here, and we got rejected at the bear gap again. This time it was paired with the 30-minute 200 moving average. We got rejected there, dropped back down to the 35 EMA right here, and then last Friday we gapped down. We gapped down all the way down to the bottom of the implied move. So if you did have orders in for 559, 557 bull put spreads, those would have closed up 100% because we did bounce right on the bottom of the implied move, and we came back up and closed relatively flat from where we opened. We did still close down 0.27%, but for how we opened and where we closed, the day was relatively flat. We also did have a little bit of a support right here, and between that and the bottom of the implied move, we did bounce right there. So we gapped down, and then right off the bottom of the implied move brought it right back to the 35 EMA. And SPX, we opened right here and we closed right here. So you could see completely flat week. And right here is Monday. Monday we took it right up to that bear gap and got rejected. Then the day before FOMC, we gapped down, and then for FOMC, we got back above this 35 EMA, took it to the 30-minute 200 moving average and bear gap combo right here, and got pushed back down to the 35 EMA. Friday, we gapped down. We filled this bull gap. This is where support was. Bottom of the implied move, 5,600. We bounced back up. I did post the trade to take 5,600, 5,585 bull put spreads. Those would have closed up 100%. So we did take it all the way back up, trading the entire bottom of the implied move, and we did actually close green in SPX on Friday. And look at the 30-minute 200 moving average. The 35 EMA is still underneath it. This is still a bearish setup. So until this 35 EMA crosses back above the 30-minute 200 moving average, which is resistance right now, we are still bearish here. But you can see that those levels are really close together and they need to be on your chart for tomorrow. So SPY did close down 0.27%. SPX closed up 0.08%. VIX closed down 2.63%. And we did close within the implied move. So flat week from start to finish, 30-minute 200 moving average resistance, and also the bear gap is resistance. We are still trading underneath the 200-day moving average and underneath the weekly 35 EMA. If I remember at the very end, I will take it all to the weekly time frame and show this from a different perspective. And QQQ. QQQ last week we opened right here and we closed right here. So flat week. We did start Monday with a attempt to get into this gap and we got rejected. We gapped down for Tuesday, and then for FOMC we got above this 35 EMA, and we did see that as support right here is where we did get that rate decision. And Jerome Powell speaking, we tried to get above this gap and 30-minute 200 moving average, and we saw that as resistance. We got pushed back down to the 35 EMA. Then on Friday, we did gap down to open, and 473, 470 bull put spreads. I did post this idea. The premium was decent right here. So if you sold those right away, if you had those orders in before market open, would be best, because we did open with that move down. And once we start trading away from that, there's not as much premium down here. So you have to be ready. So 473, 470 bull put spreads did pay. We did swing back up to close green, and QQQ did close up 0.33%. VXN closed down 1.97%, and we did close within the implied move here. And here again, we do have the 35 EMA underneath the 30-minute 200 moving average. We're seeing this bear gap as resistance, and we're trading underneath the 200-day moving average, and the weekly 35 EMA started to tilt down. And I did just mention that this 35 EMA is underneath the 30-minute 200 moving average, but I didn't mention that that is bearish still until we pull this 35 EMA above the 30-minute 200 moving average. We could see this as a resistance. This 35 EMA could come up and get rejected at that level, and then we would see lower. And IWM, we did open the week. Let me set up right here really quickly. We did open the week right here. We did close the week right here. So flat week over here again. And we did open the week pushing into that down gap from the previous week and actually closing it out. But then the next day we saw another gap down. This was the day before FOMC. We traded completely sideways along the 30-minute 35 EMA. Wednesday we had FOMC, and we did come up and fill this gap, but we got rejected once it closed, dropped to the 35 EMA, and this is where we got that rate decision. And we did pop back up when Jerome Powell spoke, got above the 30-minute 200 moving average, and we actually closed right here, right on top of that 35 EMA. Sorry, I'm wrong about that. That candle is green. We did close right here. So on Wednesday, we did close above this 30-minute 200 moving average. And then Thursday, we dropped back down to the 35 EMA. And you could see, if I take out the price right here, that 35 EMA came up. This was around FOMC right here, brought it back to the 30-minute 200 moving average, and then we got rejected on Friday. So 30-minute time frame is at a critical point. The 35 EMA got rejected there and is still underneath the 30-minute 200 moving average. So price on Friday, we opened with a gap down all the way to the bottom of the implied move. 202, 201 bull put spreads. If you did have an order in for those, they would have filled. And then from there, we did swing back up to the 35 EMA. So those would have closed up 100% for you. IWM did close down 0.62%. RVX down 2.77%. And we did close within the implied move on Friday. And lastly, we have DIA. DIA did actually have an up week. So we did start the week right here, and we closed the week slightly up just underneath the 200-day moving average. So everything else traded pretty flat week over week. DIA had a slight up week. And we did open the week right here, and then we took it to the 200-day moving average, got rejected there before FOMC. Day before FOMC, we stayed close to that 35 EMA. And then Wednesday, we see that big pop up to the 30-minute 200 moving average. That was right after the rate decision and Jerome Powell speaking. And after that, we did close right at that 200-day moving average. Thursday, we dropped down and popped back up to the 30-minute and then dropped back down to the 35 EMA. So stayed range bound a little bit there between the 35 EMA and the 30-minute 200 moving average. Friday, we gapped down all the way down to the bottom of the implied move. Now, I posted a different spread than what's out here. I stuck to the $4 spread, but I posted 414, 410 bull put spreads because the premium was good there. We got into this section right here below the bottom of the implied move, and there was room to do that. So 416, 412 would have paid also, but I posted 414, 410, and that closed up 100%. We did swing back up. We closed right above that 30-minute 200 moving average. We're still bearish here with this 35 EMA underneath the 30-minute 200 moving average. We're just underneath the 200-day moving average in DIA, and this 30-minute 200 moving average is actually coming down. If it gets underneath the 200-day moving average, that's an added bearish signal. DIA did close flat on Friday, down 0.12%, and we did close within the implied move. So really fun week, really fun day on Friday. And let's look on, this is back to SPY. Let's look at the 5-year chart. This is the weekly candle, and we are looking at the 35 EMA here. This is SPY. So 35 EMA, this is our second week underneath it. So last week we closed underneath it. The week before that we closed underneath it. And you could see that the 35 EMA is a very clear resistance or support level. So right here, this is in January of 22, when we got above this, when we closed underneath this 35 EMA, we did actually come back up and test that 35 EMA. We're not doing that here. We still might, but on the weekly time frame, we have a red signal line and we are underneath the 35 EMA. So we need to look to this 35 EMA as resistance right now. When it is a support, it is a very strong support. And when it is a resistance, it is a very strong resistance. So right now we're printing red candles and we're definitely getting moves in both directions, but just be aware of that level. I do have it on the 30-minute time frame. And SPX, same thing. We are underneath the 35 EMA on the weekly time frame. That's not fully bearish, but it is neutral leaning bearish. So here again, SPX, the 35 EMA is a very clear support, and when it's resistance, it's a very clear resistance. So we are underneath it. We could pop up to test that level. Right now futures are green, and let's measure out how far that 35 EMA is. It's, I'm going to say 2 or 3%. No, just 2% right here. 35 EMA is 2% above us. And even if we take it all the way to that top of that channel, that's about 4%. We could move up and still see that level as a resistance. So just know that's there. I know for day trading, it's not a big deal. Oh, let's go back to the 5-year. Okay, QQQ. Right here, we are underneath this 35 EMA. We have not been underneath the 35 EMA printing red candles since right here. That was January of 22. So after that first candle, we did come up and we did see that level as resistance. We did have a red signal line back here, and we have a red signal line here with a bearish divergence. So 200-week moving average, if you are looking out into the future, which I don't trade that far out, but if you are, that is a high probability that we hit that over the next year. IWM, this is on the weekly time frame, and in IWM, we dropped all the way down to the 200-week moving average. So what happened the last time we dropped from highs to the 200-week moving average? IWM traded sideways for, I'm gonna measure it out, but I think it was like 600 days. So right here is where we dropped to the 200-week moving average, and this is where we became bullish again. So 574 days of sideways price action, and these are huge moves. Again, this is a really big time frame, but we are at a critical level here. We've been underneath the 35 EMA for 3 weeks now, and we're bouncing on that 200-week moving average. That was a little technical bounce right here. And DIA is not quite printing red candles yet. So this is going to be an interesting week. We are underneath the 35 EMA, but within a reasonable threshold to not panic yet. So this week, let's see if we get a red candle or see if we get back above the 35 EMA. We do have a red signal line here, and we definitely have not hit oversold yet. So plenty of room to go. 200-week moving average, a realistic target if we do print a red candle. And again, be mindful that even though the 200-week moving average would be a target, it wouldn't happen in a straight line. All right, really good stuff. So as of today, I'm going to start making the next day's trading range available to members only. I'm going to keep doing the daily review the way I always have, available to everyone, but the next day's trading range will be for members only. And then further down the road, I have a second membership that is a little bit more. That please don't get that membership right now, but that's going to be when I do lives, and I'm going to introduce live trading sometime in the middle of summer. So for now, I hope you guys join me for the second half of this video, which is going to be members only, for tomorrow's trading ranges. That will be up in about an hour, and if not, I will see you guys tomorrow night.